Welcome back to Finance Friends. I'm your host, Fabian, and this is season 4. This season, we're diving deep into the world of investing. Not just where to put your money, but how to think like a professional investor. We are bringing you conversations with highly intelligent, incredibly motivated investors. With weekly episodes, make sure you stay tuned in. Today's episode on Finance Friends podcast, we had Ryan McMillin. Very impressive. He had the highest performing fund in Australia a couple of years ago at 122% in the year. He's also built out products for the Rolling Stones. And now he runs and co-set up a business called McMillin Capital. And they have a couple of funds, but their main fund is invest in digital assets and gold. Listen in. Welcome, Ryan, to the Finance Friends podcast. Good to have you in. We're just talking about one of our previous guests who you know quite well.
Yeah, no, thanks for having me in, Fabian. Yeah, we're just talking a bit about CJ, who's on our investment committee and does sort of help us wind back a little bit out of the crypto bullishness and bring a bit of macro perspective, which we found really useful, particularly over the last year.
And CJ means, Chris Judd, which people might not know him as CJ. So, you talked about your fund. So where are you from?
Yeah, okay, so I'm from Melbourne, from Mornington Peninsula. I live in Sydney now.
Yeah.
Started the fund with a friend of mine from the Peninsula days. A high school and university friend. He took a different path to me. He was much more on the tech side. So he had a tech startup, and that sort of got him involved in crypto. And I'd gone to London, worked in hedge funds and asset management over there, much more traditional, and I was quite a skeptic on crypto generally. When I came back, we started to have more and more conversations. And I just sort of found a lot of the things that I thought of, the misconceptions I had, weren't really based on anything real. And I had all these misunderstandings. So, it was February that I started to buy some Bitcoin and some Ethereum. And within 4 months, we'd launched the fund. So I took it really, really fast. I went down the rabbit hole, read so much material, and got.
And what year? February of which year?
So that was 21.
21.
Yeah.
Yeah. Okay. So over 5 years ago now we're recording.
Yeah, that's right. So I call it my cryptoversary. It's last weekend. So that's 5 years.
So and the name of the company is called McMillin Capital. Is that right?
Yeah, that's right. So a Merkle tree is a cryptography term, and it's how different values are hashed together, and it looks a little bit like a tree, and it's named after a guy called Ralph Merkle. So it's got a bit of a tie-in into the industry as well, and we like the concept, the visualization of a tree as well, so it ties nicely into TradFi, we think.
And how many, do you have one signature fund that you run, or do you have multiple different funds?
Yeah, we've been running one strategy, which is a pure digital asset play for a little over 5 years now, and that's done really well. And we've recently, earlier this year, we launched a Bitcoin and gold fund. We really got into the debasement trade, and we think that's going to be an enduring position to hold throughout the next probably 10 years potentially. So we thought this is a nice way to get more investors to dip their toe into Bitcoin, but really dampen the volatility with a big gold position as well, but play on that same thematic.
So debasement, for our listeners that haven't heard, it's been a big term in the markets or finance industry for the last few months now, especially since Trump does what he wants, when he wants, how he wants, or tries to at least.
Yeah.
So can you explain to our audience, what does debasement mean?
Yeah, I think it's been happening for a long time, or the trade has even been happening, but it wasn't. I think it was really JP Morgan who brought it to the fore, which is maybe that 6 months ago, and started saying, yes, there is a debasement trade and it is Bitcoin and gold, and lumping those two assets together. Before that, we obviously had Larry Fink talking about Bitcoin being digital gold. So they were sort of being paired together already in that, and then putting that nomenclature on top of debasement, which is really protecting yourself against excess government spending. We know all over the world governments are spending. There's bigger deficits. That creates inflation is theoretically what we believe. And one of the ways to protect yourself is hard assets like gold.
Yeah, and I guess debasement is moving away from the US dollar because is that right, or because you obviously, or is it more just because Obviously, the government can decide to print more money or release more treasuries effectively.
Exactly. But it's not just the US dollar, it's any fiat currency, right? So it's really removing yourself from that sovereign risk where indebted sovereigns all around the world. Obviously, the largest one is the US, and that's where most exposure lies. But it turns out the US is probably debasing less than a lot of these other countries as well. So it's often referred to as the cleanest dirty shirt in the room. So. But either way, gold gets you away from that sovereign risk, and there's new sovereign risks now as we sort of move to something like a bit of a pre-war footing. You can see, there's trade wars going on. There are some actual wars going on. There's a tech war going on potentially. We saw the US cancel some Russian treasuries or some Russian-held treasuries, and that's where the real sovereign risk starts to come in. Other countries see that and say, oh, that country can cancel my treasuries. What can't they cancel? Gold or Bitcoin?
Yeah, and that's the key. If there's a Bitcoin, there's only limited supply, and gold, obviously, it takes time to dig it out of the ground. Yeah, and it's the store of value.
Yeah.
So what's is there a correlation between Bitcoin or digital currencies and gold? And is that correlation changed a bit over the last 6 months or so?
Let's just talk about Bitcoin for a little bit, because the rest of crypto is trying to do something else. So that there are some Bitcoin-like competitors in the crypto space, but for the most part, most of it is trying to do something else other than be a store of value. There's a couple like Zcash or Monero, which are privacy-oriented.
Okay.
And so they have more privacy on top of their transactions, and they have a similar supply schedule. But for gold. Sorry, I forgot the question now. I've gone off on a tangent.
The correlation between
the correlation,
gold and silver.
sorry, yes. Yeah, exactly. So if you zoom out, there's a really good correlation. They're both going in the same direction, and I think we would have all seen lots of charts last year of gold is going and Bitcoin will follow, or global M2 is increasing and gold will follow and Bitcoin will follow. But in the shorter time periods, they're actually pretty negatively correlated. So that's why we put them in a portfolio together. You can sort of arbitrage. One will typically run first, and whether you say gold or Bitcoin is going first, it doesn't really matter. They are one sort of like a risk-off debasement hedge, and one's a risk-on debasement hedge. So they can perform differently, and that's why we think they're really complementary together. But zoom out, and that they're both sort of traveling in the same direction.
Okay. And in terms of your fund specifically, do you only invest in Bitcoin as a cryptocurrency, or are there other currencies that you invest in? And do you call them cryptocurrencies, or do you call them something else?
Yeah, we like digital assets. I think the world's sort of moving in that direction. Crypto can have a little bit of a negative connotation with it, and a lot of people in the industry would put Bitcoin outside of crypto or cryptocurrency, although they're all cryptocurrencies. They're all cryptographically secured, so technically they all fall under that umbrella. But there's different people with different views on where that sits. I think cryptocurrency is fine, or digital assets is really where we're moving to, and that sort of starts to include things like stable coins. And these are assets sitting on a blockchain that can move digitally, therefore, at the speed of light effectively.
Yeah, okay.
And so our funds, so back to our funds, so the Bitcoin and gold fund, that's Bitcoin and gold only, those two assets, and that's it. Where the digital asset fund, that gives you access to a broader range of thematics within the ecosystem. So things like Solana and Ethereum, they're infrastructure plays, if you will, on which things like stable coins, and even now we're starting to see more digital assets like gold is also now being tokenized, and we're seeing equities being tokenized. So you can trade a Tesla share, we can send them to each other on our wallets, or we can buy it over the weekend, trading 24/7. And these are sort of really nascent stage, but really starting to showcase the dream of what crypto and digital assets can mean and do.
So when you say you buy the tokenized version of a Tesla or a gold, what does that mean? Can you bring it back into layman's terms?
Yeah, a nice easy way to think about it is like buying an ETF. It's sort of like this is the wrapper through which you're purchasing it. For the gold that we hold in a tokenized form, that has designated gold bars in London in vaults, the same as you might find through an ETF. So the chain of ownership is exactly the same, or very similar at least, and we can go and change our tokens for actual physical gold if we want to. Okay. So you have the right to do that.
So it's just So effectively holding it, but you just don't hold the physical.
Exactly. So it's much easier to transfer, and that's sort of that layer that sits in the middle that makes it a lot easier.
And how do you decide the holding of like gold versus your Bitcoin? And is it just like physical gold through ETFs, or are you buying gold companies?
No, so that's right. So we're just a direct commodity play on this. So we're not looking at getting involved in equities, be they miners or even be they Circle or Coinbase. We're not doing an equity play. We're going straight to the source, right? Not proxy trading, if you will. We're going direct to the actual commodity, if you like, which is digital in some form.
Yeah, interesting. And how can you talk to us a little bit about the fund? Obviously, it's been running for 5
years.
Into 5 years now. What's been your biggest learnings over that period?
Yeah, each these infamous crypto bear markets are pretty well known to be pretty brutal. 80% drawdowns. We're currently in the middle of one. We think we're probably down 50-ish% at the moment. They do sort of have a diminishing returns profile. The market structure has been higher highs and higher lows. So we zoom out, we're clearly in a bull trend and adoption trend, and that's certainly moving in the right direction. So for us, it really is about for us to work well in this space, we have to be really high conviction, and to be able to get out of the way. And you're saying gold and Bitcoin and digital assets. Those digital assets are typically much more higher beta. So at times like this, we want to be rolling risk out of the portfolio and into gold. And that's what we've been doing over the last 3 months to sort of take a little bit of that risk and volatility out of the portfolio, and then look for signs of a bottom, which we think will be happening over the next few months, and start to. So
it ultimately gives you the levers that you can pull if you feel that there's momentum, and if you're close to the bottom, then you can allocate more to gold, and if it's the other way around, then you can allocate more to Bitcoin.
Yeah, so we call it a risk overlay. That's right. So we're looking at sentiment data. We're looking at on-chain data. On-chain is a new science, a new data science, if you will, that's specific to crypto. So we can see real-time transactions happening on-chain, and you can see where all the activity is.
Yeah.
At the moment, you can see there's 110 million transactions a day on Solana or on average. So that's really high for what which is a bear market. We are in a bear market, but there is a lot of activity happening, and that's much higher than it was, in 2022. So that gives us a lot of confidence that the fundamentals are still good. We look at macro as well. Macro is a really big part of this. Obviously, Bitcoin is clearly a macro asset these days, and that follows the broader markets. And we do a little bit of TA as well. So I think TA can help you be a little more tactical as well. So, we combine all those things together and sort of give ourselves a risk weighting, and that's where we sort of go and implement the portfolio on that basis.
Yeah, so TA for our listeners is tactical allocation, where you can be a little bit more flexible.
Yeah, technical.
Yeah. Oh, technical. Sorry. Yeah. Awesome. Thank you for sharing that. So, and how much have you, where is the fund at in terms of asset size? And I imagine that sort of fluctuate up and down depending on sort of market cycles.
Yeah, it does. We get really good inflows, obviously, at those more euphoric stages of the market, which is a shame. That means, investors are buying the top, and this is pretty synonymous with Bitcoin as well. You always hear the stories of people, buying the top and sort of selling the bottom as well after 12 months of downward, of poor returns. They sort of capitulate, and that signals the bottom, and off it goes. So, our return flows, along those lines. When we launched in 2021, everybody we spoke to invested. We were like 100% strike rate, and we got 5-6 million really quickly. Went through a bear market that was pretty tough. Then we got back over 25-30 mil. About 12 months ago, and that's been a little bit of a decline as the market sort of softened a little bit. And we've had some great returns in that time as well. We were the best performing fund in Australia, across all funds and all asset classes for 12 months, and top 3 for 2 years running as well. Yeah. So, we got some nice coverage in the AFR over that.
Yeah, I did see that. So you returned over 100% in 1 year, is that right?
Yeah, 128% in 1 year and 107 in another year, consecutive year, so 23 and 24.
Yeah, well, congratulations. Well done.
Yeah.
So, and I saw a chart actually the other day around the return of I don't know if it was Bitcoin specifically or other digital assets. that every 4 years there seems to be a big drawdown.
Yep.
How much does that play on the investor's mind? And as soon as it hits 1 January or even 25th of December, you put some money in because knowing that year 5 or year 1 again of the cycle tends to be bullish.
Yeah, that 4-year cycle is associated with the Bitcoin halving cycle. So every 4 years, the emissions of Bitcoin are cut in half. So the miners, there's a mining cohort who are printing blocks of Bitcoin. That's every 10 minutes. All the transactions will be wrapped up. One person will get to print that block and move on. They get a reward for doing it. Those rewards are halved every 4 years. So that's why we see these really strong 4-year trends. So we had another peak right on schedule, October last year. That was like clockwork. I think a lot of people in the industry, including us, had expected those 4-year cycles to weaken a little bit as more and more institutional money comes in. We've seen a lot of flows from these ETFs, and they're more advised clients and more institutional clients who will have a 2% allocation. If the market underperforms, then they're going to have to top up, and we think that takes volatility out of these moves. But nonetheless, there's still a lot held by the OGs, if you will, and they're the ones who are following these 4-year cycles more accurately than others. So,
do you know the breakup of institutional investors versus retail investors in Bitcoin?
Yeah, so it's hard to see through, obviously, everything, but I can tell you in ETFs and in companies like MicroStrategy and other digital asset treasury companies, it's around 12% of the market is now in those. So we think that's fair to call that more institutional, often through advised channels. But then there's obviously, the US government has 300,000. There's a bunch of sovereign wealth funds who are not included in that cohort. You could sort of speculate it's a little bit higher than that.
Yeah, and obviously the more likely, the increase in adoption from wholesale and institutional investors, it means the volatility should reduce because as prices go down, people will top up to rebalance their asset allocation or see an opportunity to invest at lower prices. Yeah. Whereas on the retail side, people do a bit the opposite. When markets have gone up, that's when they invest.
Being contrarian is not easy. Yeah, absolutely. And we think we're in that sort of bottoming sort of phase at the moment. So I think, if the 4-year cycle continues to play out, then in October this year, that will be, around the bottom, and we probably track sideways from here to there, meaning, DCAing through that period will get you some great entries, and you'll be set up for, a typical bull market that goes into the next halving cycle. So, it's a little bit too simplistic sometimes because there's a lot more macro at play, and this is a macro asset, but at the same time, it's worked and it continues to work. So, you know what? The cycles are true until proven otherwise.
Yeah, exactly. And DCA for our listeners, dollar cost averaging, I assume.
Yeah, yes. That's right. Yeah. It's my first role out of uni was in financial planning as a paraplanner. So we talked about DCA there, and at that point, I thought, this doesn't make any sense. You want a position, get in there, just hit it. But in an asset this volatile, DCA makes a lot of sense.
Yeah. I think there is research around DCA, and it's actually because assets go up. So the probability of, over the long run, your probability of if you are dollar cost averaging, it benefits you less than investing all in one time.
Yep.
But it's also about, psychology as well. And
there is. And the volatility of this asset class particularly, I think makes it, more beneficial, certainly.
Yeah, it's interesting. So I've had some asset managers on, and I listen to a lot of podcasts, and when shares that you have been watching that or digital assets have been sold off substantially, there's an opportunity to buy. So if it goes at, you want to buy it at $20 a share as an example, and it's at $22, if it goes down to 20, then you want to buy it and you buy it. Now, if it goes down to 18, if you're willing to buy at 20, you should be willing to buy more at 18.
Absolutely. So, No, and we certainly see that with Bitcoin. If you like it at 100K, you should really love it at 50 if it gets there, or 60 when it's around now. So
where do you see it going? And how does because obviously Bitcoin is, Bitcoin to USD is the number that we see and relate to. And with depreciating USD, that's obviously worse for Bitcoin. Do you guys talk about where you see the floor for this year? Now we're in February. There's a long way to go.
Yep.
Is that discussed internally? Do you publish any of that research externally to the market?
Yeah, we don't like to put too many, dollar predictions out there because they're always wrong, right? And people come back and say, look, you said this and this happened. But, we're putting more faith again in the 4-year cycle. And if you just want to step back and say, look, that is what is driving the market currently. And it does look like it is because the fundamentals are still really strong. Like I said, there's a lot of transactions still happening. You've got central banks even starting to buy little bits of Bitcoin in experiments. So the fundamentals are really good. So let's just pretend for a second that the 4-year cycle plays out. Then you should expect sideways chop from now until October, and then a recovery bull market, and then one of these blow off top, which are really exciting. So could we go down to 50-ish? That's certainly possible. But equally, could we rebound from here very quickly? We didn't really get a blow off top in the last bull market. So, we just got a few all-time highs, a little bit higher, but none of that really parabolic move that we've seen in previous cycles. So potentially, we think there's also, a pretty good probability that this bear market follows that suit and is not quite as steep and probably as long as previous ones. So, it's balancing those two.
And for any investors that, may have not tipped their toes in the water, so to speak, in digital assets, what would you say to them to maybe give it a shot as to why you feel, so strongly about digital assets?
Yeah, I think the best thing to do is to actually dip your toe, get a small position, and then you will pay a lot more attention to the asset. There's no way better of learning than doing. And equally, that's how I started my journey myself was, put $1,000 into Bitcoin and Ethereum, and I started to read more about it. And that was in a bull market, which is helpful. So that went up very quickly, and then you pay a little more attention. Okay, well, what is this asset that I'm actually holding, as opposed to sitting on the sidelines? It's quite easy to take the negative view because you're actually out, and emotionally you're sort of looking for confirmation bias to say don't buy it when you're out of the market. So I think take that little position, start to be curious, and learn for yourself.
I agree. Once you've put some money into something, you're more likely, anything, totally. You're going to research it more and look into it more. And then, and
don't listen to anybody who starts a sentence with, I don't understand Bitcoin, but, and that's, Michelle Bullock is one of those. And there's a lot of people that sort of go down that path. I don't know what it is, but I'm going to tell you what it is. Like, well, that's not a great starting point.
Yeah. The way I look at it, you might even lose money on your first investment, but if you learn something about investing, you've gained a lot more than the money you've lost.
Absolutely.
Yeah, so that's mine. And I want to take a step back because you talked about working in traditional investment management or hedge funds. So where did you start your career? Maybe let's not go back to paraplaning days, because I did a little bit of work in paraplane. I hated it. But let's go back to what was your first role in a big institution?
Yeah, so after a little bit of paraplaning, I was about 12 months out of uni. I was actually part-time at uni doing that, and then I moved over to Mercer here, just across the road, where they were then anyway, into Mercer Global Investment. So that was, very operational, and that was, getting data together in spreadsheets for the funds, and then a little bit of product management on the side as well. And then I moved to the UK pretty after a couple of years of that, and really carved out my career in product management and product development, which is probably a different path for most people to get to CIO.
With Mercer?
No, so then moved to some UK firms, Bank Saracen, so a big private banks, London investment firm. It was a really interesting place. My first job there was actually creating a fund for the Rolling Stones. So they had some really high profile clients there, and that was my number one job in the door.
So when you say creating a fund for the Rolling Stones, let's bring that back. Is it a royalty fund, like for their songs, or what does that mean?
No, so it's just investing their money, but it has to be in a certain structure. In the UK, you've got so many choices of where you can domicile a fund and the tax implications of that. So they want it in a specific place with specific owners, obviously, and right for the right tax benefits. So a lot more structuring happens in the UK. And so that was a big part of what I did. And then it was also looking at really new strategies as well, which is something I was always drawn to. Be like catastrophe bonds was a really cool product to get involved in. I brought risk parity funds to the UK as well. So Panagora, I was always a big fan of Ray Dalio and his all-weather fund.
Yeah.
I came across that early in my career and I'm, wow, how cool is this? Okay, and sort of start to understand it, and then was lucky enough to actually bring those that strategy, the first people to bring that to the UK and some other really cutting-edge stuff that I found really interesting, which is probably what led me to keep an open mind into Bitcoin as well.
Yeah. So you talked about an all-weather fund and catastrophe bonds. Actually, one of our clients, they distribute a US fund that does catastrophe bonds. Can you explain to our audience what a catastrophe bond is?
Yeah.
Because if I do, I'll get it wrong.
No. Yeah, we call them cat bonds or catastrophe bonds. So this is a fund, and it's effectively you're taking away the market risk of the bonds. You're now the risk you're taking is catastrophes happening around the world. So an insurer who insures people for catastrophes, cyclones or whatever they might be, flooding, they will put some of that risk with the fund, and the fund will wear it. So your returns are really good if there's no catastrophes through the year.
Yeah.
And if there's a lot of catastrophes, your returns aren't so good. So
you-
no market risk or a different, very, very different risk exposure.
So you become the insurer, ultimately.
That's right. You're reinsuring. You're part of the reinsurance business.
The underwriter.
And you've got some really uncorrelated asset there.
Yeah, which is really good. If you want a high yielding product.
Yep.
But obviously bearing the risk of something like this can happen and might take away some of that return.
I mean, the primary thing you're trying to do here in portfolio construction is bring together uncorrelated assets, and that will enhance your risk-adjusted return. That is, the bread and butter of portfolio construction. So anytime you find an asset that has non-market correlation or non-perfect market correlation, it will enhance the portfolio. And Bitcoin, ticks that box perfectly for us. So do a bunch of other.
Yeah. So obviously, your time in the UK with these funds, it helps you to understand looking at different asset classes that give you different investments that give you a positive return but uncorrelated. So, if global equities sells off, you're still your cat bonds or your BTC and your gold fund is doing well.
Yeah, exactly, and that helps the portfolio over the long term.
So, and what firms did you work at? So, I've got Coots listed. Did you spend some time at Coots Bank, the Queen's Bank, as some would say?
Yeah. His Majesty's now, but Her Majesty's there when I was there. So that was really interesting. I think anybody and everybody who is someone in the UK banks with Coots, it's sort of like a household name there. But all the Premier League footballers, all royalty, all the CEOs, everybody, sort of banks there, and they want to be there because Her Majesty is there, and she'd occasionally come in for lunch, and we'd wave at the door to see her come in. So that was a really interesting place to work. They had some really old funds there, and I helped update those to bring them into a new structure and new investment profiles to better suit the go forward model, because a lot of these funds were 40 years old and had a long history, so they needed a bit of updating. And that was part of RBS Investment Bank as well. So I did some work for them, bringing their structured products into existence as well.
Yeah, because structured, I spent some time working in private banking in the UK, Julius Baer Swiss Private Bank, and structured products were very popular with our audience. I think become the bank has taken a little bit more less risk or risk off with those products that they're providing to their clients now. But it's quite unique with their offering and the different products that are available in the market in the UK. Yeah,
that's right. There's a lot more choice and a lot more innovation happening over there than we typically get here. There's lots of great things happening here, don't get me wrong, but there's just a little bit more happening in that sort of centre. There's so much more pools of capital that are looking for a home over there.
Yeah, when I worked in Julius Baer in London, we used to look after a lot of Middle Eastern clients actually, and for them it was just getting assets out of the Middle East because to mitigate risk of something happening, and then at least they have assets elsewhere in a safer country.
Yep.
That's great. And so how long did you spend in the UK in total?
Yeah, 10 years. 10 years in total. Yeah, so I got citizenship there, and that was sort of the catalyst. Okay, if I don't go and try move home now, then I might be stuck here for a while. So I thought, let's try it now. And that was just after the Brexit vote as well. So things were getting a little, what would you call it? There's a little bit more conflict, I guess, and a separation between the London and the rest of the country, and either way, it was a good time for me to leave, and I sort of left just before COVID as well, which was probably good to get home and have that in Sydney. Was a not so bad experience than some others. Yeah,
especially if you're short distance is within the beach or distance of the beach, at least you can go for a swim.
Yeah, we used to go surfing, so it was not so bad, right?
Yeah. So then you came back, and then as soon as you came back, you set up the company, or were you working?
Yeah, I did a couple of years here. So one was with BNP Paribas in Sydney, and then with AMP Capital as well for a year. So I worked on some projects with them, and during those times, just having these conversations with Dean, and I was quite skeptical at first, but I did, eventually put in the time to sort of understand what he's talking about and whether he's actually got a point here, which was absolutely. If you don't put in the work, you're not going to have the conviction either. You can't just buy something without the conviction and expect to be able to hold through a bear market.
Yeah, I agree. And where do you see the business going? Do you plan on releasing more products? Do you have international investors as well, or is it just domestic at the moment?
Yeah, we've got a handful of internationals. We're talking to Singapore and Hong Kong. They're sort of the local area and mostly family offices there. We're also looking at a Cayman structure as well, so that would really help with international distribution. International investors don't really love an Australian domiciled wholesale unit trust, which is what we run at the moment. That's great for the domestic audience, which has been our bread and butter. We get a lot of self-managed super fund investors come through because it's a nice way for them to get good managed exposure to the ecosystem without having to press the keys themselves or decide what to invest. So there's certainly scope for us to go internationally a little bit more, but we need to have that strong base here, and that's what you sort of do during the bear market is sort of build those contacts for when things pick up a little bit. You're ready to go.
Yeah, and a lot of these institutional type investors will do due diligence, and it might take 6, 12, 18, 24 months before they're comfortable with you and to allocate capital to you. And in terms of your investor, how long is the average? What do you recommend you invest for? A 5-year period minimum? Is that sort of the goal? Obviously, it's not a lockup. It's access. Do you give access to capital if someone wants to withdraw? But what do you recommend for your clients in terms of tenure of investment?
Yeah, so we've got monthly liquidity, so you can come in and out at the end of any month. Which we don't like the concept of lockups. Everything we invest in, we don't go down to the VC route, so there's no locked up or capital restrictions on anything we invest in. We sort of focus on the top 50 to top 100 of assets, so everything's nice and liquid, and we think that's the safest play to bet. There's a lot of returns still in that space without having to go out the risk spectrum. And in terms of individuals, the IM suggests 5 years, but we think a little bit longer is preferred. You've clearly got these 4-year cycles. You at least want to ride out one of those as a minimum, and ideally 2. But most of our investors are in for the long term, and they're thinking 10-year plus, and we think that's the great way to do it.
And I think if a lot of your investors did get in 2021, 2022, they've had the 100+% year, so. It's difficult when someone looks at the 122% and puts money in, and then you might have a negative year. And then it's you'd be almost better off waiting for the negative year than putting money in. So
definitely, and that's the DCA approach as well. So through 2022, those people that did top up, they really came out of it really strong because they got really good gains on the back end of it. With the ones that just sort of rode through, they did okay. But if you can get some really good entries, you bring your average price down. That's really good strategy.
Yeah, and we had another guest on the podcast earlier in the year who works at AMP Super, and he said they've just started allocating to Bitcoin for their super funds. So, which is really insightful and learn a lot about blockchain.
But I do know some of the guys at AMP, and they really happy with what they're doing, really pushing the envelope there and starting to get a little bit Bitcoin exposure. Most other super funds are not there yet, but you need one trailblazer.
Yeah, they're slow adopters to super funds, that's for sure.
Yeah,
they're
definitely.
Slow to move.
And that's true of all traditional finance, right? It's a lot easier to wait for someone else to cut that path. And we're seeing it happen in the US a lot more as well. Regulations obviously moved on in the US a lot. And those bigger, Morgan Stanleys and the like are recommending 2, 3, 4, 5% exposure to Bitcoin. We're not here here. We're not there yet, but I do think in the next year or two we'll start to see that become the norm, and small allocations will be quite reasonable.
Yeah, I think so too, and we'll see how the next 12 months plays out. So I won't ask you to give me a number on Bitcoin for the end of the year, but I reckon, what do you reckon, Sienna? Maybe December, let's go with 75,000 US. Should we go with that? That's
happy with that. A little higher, I think. A little higher. Yeah. I'll just,
what are we? So as of recording, what are we at? 62,000?
Yeah, 62.3. Yeah, I think so.
At the moment. So this is on the 24th of February, but we know that can change pretty quickly.
No, that's right. I wouldn't be surprised if we had a bit more of a leg down or a little bounce, but definitely some sideways chop should be the base case. But I think we'll come out of this really strong like we had every other time. So now is the time to start dipping your toe and start learning the asset. That's
awesome. And your funds are only available to wholesale investors, is that correct?
It is, yeah. So it's wholesale only. It is a volatile asset, so we think that sort of makes sense. You can get ETF exposure as well for smaller amounts for people that want to dip their toe, and that's a really good way to not have the custody concerns. And we think we can add some more alpha on top of that when people get there. Yeah,
well, I've enjoyed the chat, Ryan.
Likewise.
Thank you. Is there anything else you want to share with our audience? I'm looking forward to the growth of the business and
thank you.
Hopefully see another 100+% year.
No, we'd love to get some more coverage like that. That's that sweat earned coverage in the media is the best. Stay tuned. We think there's more funds, and there's this concept of digital equities as well. We're sort of thinking about maybe there's something we could do there that's really interesting. A few different fund ideas, maybe a yield fund as well. So we've got plenty on the table. We want to expand and grow and to do some more fun things.
So let's touch on that because can you generate income from borrowing crypto assets? Is that right? Is that
absolutely.
Option?
No, there's $500 billion locked up in DeFi at the moment and doing all sorts of things like that, generating yield somehow. You obviously take a little bit of custody risk with that, but it's about managing that. And it's a replication of everything we see in traditional finance is happening in digital finance with some new things added on, which are really exciting.
Maybe that might be for our next episode.
Sounds good.
Thank you very much, Ryan, for coming in. It's been a pleasure. All the best. We'll share all the links to your fund as well on our podcast and on our socials. And we wish you all the best for the next 12, 24, 36, 48 months.
Awesome.
In advance.
Thanks, Fabian.
Cheers. Thanks for listening this week. Stay tuned for our next episode and keep up to date with us by following the Finance Friends podcast on Instagram and TikTok. Plus, connect with us and our guests over on our LinkedIn page, all linked in the show notes.
Disclaimer. This podcast exists for informational and entertainment purposes only. The personal opinions of the speaker and guests do not represent the view of any other party. If this recording contains reference to financial products, that reference does not constitute advice nor recommendations and may not be relied upon.